On this week's Money Minute feature, sponsored by Navy Federal Credit Union, personal finance expert Jeanette Mack tells us the difference between good and bad debt.
When preparing for a mission in the military, the best way to start is with a team briefing. That way, everyone is on the same page and the mission is on track for success. It's no different when it comes to your kids and their finances. One of the biggest financial issues they will deal with in their lifetime is debt, both good and bad. According to NerdWallet.com, the average American household is more than $129,000 in debt. That's a lot of money. So you can see why managing debt is an important lesson to teach your children. Generally speaking, good debt is associated with an asset that has the potential to hold or increase its value. For example, home mortgages, student loans, and yes, even credit cards can be considered good debt. In order to make those types of loans work for you, you have to make sure you don't bite off more than you can chew, which a good lender will help you avoid. Bad debt includes borrowing from a 401k retirement account, heavily using higher interest rate credit cards, and taking out payday loans. These days, there are more financial players than ever, and some will be tempting your kids or your younger enlisted to rack up debt. It's imperative to help them learn the difference between good and bad debt, and how to get the kind that will help them to be more financially successful in the long run.
Thanks, Jeanette. We'll see you next week.